this is Nifty, this is going like this, and your Reliance chart is also going like this. So you can see like Reliance is as if it is following the market. So this was the COVID fall. Here also you have the COVID fall. Similar, very similar. But if you see the chart of Bosch India, it is something else. So it is not following the way the market is going. This is the second video of the series Security Analysis for Investment, and in this video we are going to discuss about risk, how to define risk, what is risk, and how to measure risk. So if you talk about risk, then before even starting defining risk, some negativity comes in mind, as if risk is something really bad, or we don't want risk to be included in our financial decisions. So the immediate notion of risk is that it is a negative thing. That means something bad is going to happen. But in financial language, it is not the case. Actually, we define risk as any kind of deviation that is happening from the expected value. So for example, a particular security A, suppose its expected return is 5%, suppose, and then suppose in a particular month or in a particular year you see that the actual return is 3%, and then in some other time period or in some other month or year you are finding that the return is 10%. So both are deviation from this 5%, which was the actual return, expected return, and therefore both of these cases will amount to risk. So that means 3% is also risk, 10% is also risk. Normally we understand risk as if 3% is happening, that is a risk for us, and if 10% is happening, it is a good thing for us, it is not a risk. But in financial language, you have to understand that both danger, that means less than expected value, and opportunity, that is greater than expected value, both are risk. So if this is the 5% return line, this is the 5% return line, and the security is exactly following this line, then we will say that this security is having no risk. But anything above 5% or below 5% like this is also risk, and this is also risk, and there is no preference. That means this risk is good, this is bad, nothing like that. Risk is risk. Okay, so then there are two types of risks. First one is your firm specific risk. What is that? Suppose some kind of project risk is going on, the firm is actually undergoing some certain kind of projects, so due to that project the financials are down, or something unexpected is happening apart from the expected. So those kind of risks are defined as firm specific risks. That means this is only happening for that particular firm and not for the entire market. Another example can be sector risk. That means, for example, in pharma sector or in infrastructure, some kind of turbulence or turmoil is happening, and therefore the firms representing those sectors will be affected only, not the entire market. Similarly, competitive risk, some kind of new competitor with new technology has come up in the market, and due to that reason the firms are getting much more competition and the profitability is decreasing. So that kind of risk is competitive risk, and that is also firm specific risk, and it is not affecting the entire market. And from now onwards, when we are speaking about risks in this particular series, we will not focus on firm specific risk on the whole, because the implicit assumption is that the firm specific risk is always diversifiable. So if there is an investor, it is expected that the investor has diversified his portfolio into different kind of assets: asset 1, asset 2, asset 3, and so on. So his entire money is not invested in one particular firm. He or she must have invested all his money or assets into different categories, and different categories of different firms of different sectors. So that is how the risk from firm specific risk category is getting diversified. For example, if suppose the expected return is again 5%. So due to some problem in this A3, the expected return here is 3%. But at the same time, A1, due to some specific risk element, its return is 7%. So if equal amount of shares has been invested in A1 and A3, then they will be balanced. So the average return will be again 5%. So the implicit assumption here is that all the investors have invested their money by diversifying the assets. That means their entire sum of capital is diversified among various firms, and therefore the firm specific risks is not important to us at this present moment. So we are not going to elaborate on this any further. So the only point of discussion is the market risk. What is the market risk? That is the risk that is applicable to all the firms in the same market. So for example, any changes in interest rate, exchange rate, political news, or anything happening to the overall economy is going to affect most of the firms in the overall market. So that is called the market specific risk. So normally we will focus on this particular category of risk only. So now let us understand the market risk in a more detailed manner. So first of all, note these three charts. So towards your left, this is the chart of the market. So this is your market, Nifty. And towards the left, I have taken two examples. One is Bosch India, another one is Reliance India. So you can see the pattern of the chart. This is Nifty, this is going like this, and your Reliance chart is also going like this. So you can see like Reliance is as if it is following the market. So this was the COVID fall. Here also you have the COVID fall. Similar, very similar. But if you see the chart of Bosch India, it is something else. So it is not following the way the market is going. So the point I want to discuss here is this Reliance chart is more prone to the changes in market, whereas this Bosch chart is immune. It is immune. So there are variations here, but these variations are independent of the variation in the market chart, and therefore it is immune to the changes in market. So the market risk of Reliance will be more compared to the market risk of Bosch. Why? Because Bosch is immune and Reliance is prone. That is why Reliance market risk will be more. So let us now elaborate this little more. So if the market movement is causing similar movement in the asset price, or in other words, suppose market is going up and the asset is going also up, market is going down, similarly asset is going also down, market it is moving sideways, the asset is also moving sideways. So that means whatever is happening to the market is reflected in terms of the movement pattern for this particular asset. So in that case we will see that this particular asset will have high market risk. Okay. So then what is the measurement criteria for market risk? So we will calculate the covariance between asset return and the market return. So if you calculate the covariance between asset return and market return, if the covariance is high, then we will see that the market risk for that asset is high. But there is a problem. Problem is this covariance statistic is actually not normalized. It is not normalized, which means if suppose the covariance of certain asset is say 0.45, then we cannot compare that with some other asset. So since this is not normalized, it is not possible to compare in terms of covariances. So then we normalize this by dividing this covariance by the variance of the market, and this particular ratio is called beta. So you must have heard beta a number of times in the market or otherwise also. So this is how the beta is calculated, and naturally when beta is greater than 1, we will say that the asset is more risky, having more market risk. And if your beta is less than 1, then we will say that the asset is having less market risk, and beta is equal to 1 when it is the market. That means for market, that is for Nifty, beta is always equal to 1. So now we will see how to calculate the beta actually. So we will use a spreadsheet to implement. So let us move to the spreadsheet. So here you can see January 2019 to December 2022, we have the data of percentage return for Nifty, Reliance and Bosch. And you can also collect this data. Actually, it is very easy. You can go to investing.com, and for every share, you will find this data. I have just copied this data from here to the Excel, and we only need this percentage change value because this is the return percentage. So remember, what is the definition of beta? What was beta? Beta was covariance of asset and market divided by variance of market, right? So this was the definition. So let us try to calculate that. So for Reliance, this is for Reliance. I will zoom this in so that you can see more clearly. So for Reliance, the covariance is sample covariance. We will always take sample because we don't have population data, only sample data is available. So this dot s formula we should actually use. So covariance dot s, two arrays, one is your asset array, another one is your market array. So this is your asset return, Reliance return, and the second argument is array 2, that is your market Nifty. So bracket close, this is your covariance, and what is the variance of market, right? So simply variance again dot s and Nifty. So now what is the beta? Beta is covariance divided by variance, that is 0.997. So for Reliance, the asset value, the beta value is 0.997, and for Bosch, need to calculate for Bosch also. So covariance, sample covariance of Bosch and market, then variance of market is this one, same one, and then beta is covariance divided by variance. So this is how beta can be calculated. There is another method, easy method, that you can use, that is the slope formula. Slope formula of your asset return and market return, that will also give you the same beta value. Let us check this. So your asset return is Reliance, this one, and then market return. Which one is market return? Nifty. So see, same value is coming, and for this also you can check here. Okay, let us calculate this. Slope, Bosch return, and then Nifty return. So see, same values are coming. So why this slope formula is helpful, and why this is same as this one, that we will discuss after some time in subsequent videos, when we will see the risk return relationship. But as of now, just understand that either you can use this covariance by variance formula, or directly the slope formula to derive the beta value. And what is the conclusion? Actually, in the slides we have seen that the Reliance chart was following the Nifty chart almost closely, and therefore we concluded that the Reliance market risk was higher, and therefore you can see here also the beta value of Reliance is higher, and the beta value of Bosch is lower, because the Bosch chart was immune to the changes in market, and so the market risk of Bosch is lower, and that is reflected in terms of beta value 0.84 only. So if you can just want to verify this, I have taken out the brokers page. So for Bosch India, you can see the fundamentals. So this is your 0.82. In our case, we have 0.84, and for Reliance, this is 1.05. So in our case it is 0.997. So see, this much variance can come due to various factors, because I don't know how many years of returns they are using. I have used from 2019 to 2022. I don't know what they are using. Plus I don't know which time period they are using. That means we have taken the monthly data, the monthly closing price. Based on that, the returns were calculated. Maybe they are actually taking the weekly data or whatever, I don't know. So this much variation will come, but it is very close. The actually it was 1.05. In this case it was 0.82 from the brokers page. So not much different. So the idea was how to calculate the beta value by knowing the returns, and to interpret the beta value in this case in this video. So that was my intention, and I have explained this in this video. So hope you have understood the point, what is risk, how to calculate risk, and how to calculate beta. So that's it for now. Let us meet in the next video, where we will try to discuss risk versus return relationship. So that's all. Thanks for watching.